As we enter the second half of 2010, the stock market rally of 2009 seems to be in question. Today we have back David Feather, the President and Managing Director of Russell Investments Canada, to comment on it. Welcome back, David.
Thanks, John. Good to be here.
You'd agree that basically when it comes to the stock market and the economy right now, that we're somewhere between sort of a pessimism and skepticism that there is a recovery.
I think so. I think the underpinnings of the economy are not strong enough. There's enough worrying flags there that they like to cling to the good news, and certainly you see a reaction in the marketplace every day when some good news breaks, but it does not seem to be sustained for any period of time. So I think we're clearly in a wait-and-see attitude in the marketplace, and that's certainly coming true in the very high level of volatility in the market we're seeing as well.
That was actually my next question, and I think I wrote a piece some time ago saying perhaps we're in a decade of essentially permanent volatility. This is not something that's going to go away next quarter.
Yeah, I think that's true. I mean, one of the managers we use in our funds extensively is PIMCO, and of course they made very famous the whole story about low growth and low inflation and lots of volatility, and we believe that is the case as well. And you had a decade in the 90s where you had almost every day, you'd hop out of bed and you knew you were going to make money in the market somehow, and the average S&P annual return in the 90s was 19 and change. I think it was 20 in Canadian dollar terms. And clearly, last decade, we had a decade where we had two major capital market betrayals, and both the TMT meltdown that started in 2000 and the credit crisis in 2008. So, what does this decade bring? I think we've got a lot of investors who were hurt twice very badly last decade. They are largely still on the sidelines, and that's often supportive of markets. But what will be the catalyst to get them back into the market? I don't think the confidence is there to bring those investors back in the market to really have a sustained move upwards in the market. And there's other major shifts happening in equity markets as well, in the U.S. principally, but also in other mature countries with older demographics like Japan, Italy, Spain, others. We are approaching more of a time period where there'll be increased propensity for deaccumulation amongst major defined benefit plans and other institutional pools.
Retirees withdrawing income.
That's right. And so to the extent that a lot of that money is managed around a common way of running money or around the index and what have you, that also forms as a headwind towards driving markets upward. It doesn't mean we don't think we're going to see very strong opportunity this decade. We just think that the approaches will be unique. We hope investors go back to fundamentals. You and I talked a little bit earlier about that all of the talk these days and amongst people in the industry, amongst people who are just talking generally, even in the media to a certain extent, there is a lot of fanfare around the big macro topics, and they are extremely important, and they're very newsworthy. Oil spills and credit crisis and central bank policies.
Euro.
Oh yeah, euro and inflation and all this money that's been printed. What type of inflation is going on? And Greece. I mean, these are big stories, and they are market impacting. In the short and medium term, they are definitely market impacting. But what will make a difference to the investor in the long term is not those events. It is the fundamentals of buying a good company and whether or not that was a good investment decision based on the fundamentals and holding it for a long period of time.
You sound like a good old-fashioned value manager like your friend Peter Cundall.
Yeah, well, Peter would definitely fall into that camp for sure, and as would a whole lot of other good investment managers. And one of the things that attracted me to Russell was our ability to look independently at different managers who are investing based on a very active basis in a security-specific situation. And again, not that those other factors aren't really relevant, but what will drive investor returns in a type of decade like this one, where we're probably going to see low, maybe middle single-digit type returns, your company selection and asset class selection is what's going to drive success or failure as an investor.
Do you see it as sort of this two-tiered thing where the emerging markets is double-digit growth and developed markets in North America or Europe are single-digit?
Yeah, and emerging markets is another reason why I think inflation will be muted. There is tremendous excess capacity in the Western economies and throughout Europe, and obviously in emerging markets you have higher growth, also willingness and ability to take on capacity. There will be higher returns in emerging markets. Yes, it'll be a bumpier ride as it always is in these sort of situations. But we think every investor should have an allocation to emerging markets.
How much?
Well, depending on the investor's situations. For you and I, John, it might be 20% or 15%. For an investor who is into retirement, and it might be much lower than that. It might be 3 or 4% or 2%. For a younger investor, my children and their RESPs, for instance, I would hold at least a 20% weighting to exposure in emerging markets. And you can do that directly through a whole lot of different ways to capture emerging markets. You can also do it through, to a certain extent, through a good global fund that holds multinationals. So, the old story is that you're aware of Colgate and Nestle and all these companies that have such big exposure to emerging markets.
Okay, we've come to the end of this time. Next time we're going to look at the fixed income environment and interest rates, and maybe how you can tie all this together through maybe balanced wrap accounts. So
Sure.
Thanks again, David Feather, President and Managing Director of Russell Investments Canada.
Thank you, John.